Hello, everyone. I'm Brian Chinappi. I'm a partner with Actis. I run the real estate investing business within Asia. Yeah, the impact on COVID on the various property classes in Asia is probably not dissimilar to developed markets. And so when you think about the asset classes that are most impacted, it's hotels, it's retail, assets that really count on kind of almost daily leasing, daily revenue flow, daily foot traffic. So those are the most impacted that we see across the region. And then the least impacted, again, a lot spoken about this already globally, and we're seeing the same in our portfolio as data centers, as well as e-commerce kind of focused logistics, where we're seeing the biggest kind of continuation in our investment programs, as well as current leasing and build activity. The other thing I would say is that the probably some other differences that I would comment more than just asset classes is generally how we see kind of Asia coming through, or what I would call growth Asia. And so for us, that's Greater China, South Korea, India, and some selected markets in Southeast Asia, so specifically excluding Japan. Growth Asia, in our view, is still got some real fundamental secular demand drivers that we think are very much intact. They're a little bit slowed down at the moment, but we expect that they'll come back quite quickly. So we do expect those differences. And the final point I would make is around leverage, and that the growth markets in Asia are just more lowly levered than developed markets. Trends driving Asia real estate. I think first maybe talk about kind of geographically why we like growth Asia. And I think there's three key things. The first is, again, the markets are supported by these secular demand trends, which I'll speak to in a minute. We think there's four of them. The second is that the markets benefit from what I call kind of positive arbitrages between, driven by the fact that we have many cities in our developing countries that have kind of near or even at developed market characteristics. And that gives some really interesting investment arbitrage from a real estate perspective. And then the third is that all of our markets benefit from the fact that real estate as an institutional asset class, kind of owned by local institutions, is still early days. And so, not surprisingly, a big component, almost 2/3 of what we do, is actually build to core, because the demand for high quality defensive income producing assets is so strong. Coming back to the four kind of, one of the benefits, while we have countries that are very different, or really cities that are very different across our focus footprint, we're really again focused on investing in metropolitan areas, and they have consistent demand drivers, and we've coined them what we call the 4Ds. And the first is what we call demographic shifts. And that's not just about urbanization. You'll hear a lot of people talk about how, Asia benefits from urbanization. That's important, but what's really more important is actually the densification of middle-class wealth in the cities. That's actually what is more a direct driver of real estate demand than just the mere urbanization of some of these countries. The second point that we look at is what we call digital disruption. That across our markets kind of has two components. So you have certain sectors where there's an undersupply because of digitization. So data centers, e-commerce focused logistics, kind of key on the list there. But then on the flip side of that, you get sectors that have really been dislocated by digitization. And key for us in the region is retail. Third demand driver is what we call deficient real estate supply. And this, I want to be careful about this because it's not a mere shortage of supply. It's a product gap that results from a historic and still current focus by the local development community on grade A and on product that generally is not affordable for the demand, which really leaves a big open space if you can really spot where the demand's not being met for that supply, with that supply. The other issue is also obsolescence, which drives some of that deficient supply in some of our more developed cities. And then the fourth comes back to this kind of build to core concept, and we call it demand for yield. Again, we believe it's just an unsatiated demand for income producing assets in our markets. And so those drivers are pretty consistent across all of our markets. We really focus on finding relative value, kind of driven by those drivers. And so we're focused on funding kind of the geographic property sector combinations across the region that deliver the most defensive value over the long term.